Hello, this is Ernest Osias, Director of Market Analytics with Woodall Risk Management. Thank you for joining us for our weekly technical overview of the grain markets. Before we begin, a brief moment to look at our market disclosure. This is a solicitation, and there is substantial risk of loss in trading futures and futures options. Past performance is not necessarily indicative of future results. Thanks once again for joining us for our weekly installment of the Technical Market Overview. We'll go ahead and begin. The first quarter of the year has come and gone, and the markets are operating as would be expected now that the USDA quarterly report has passed. Today we see corn, after it's been moving down along our speed line, has finally bounced up and got a nice advance to the upside post the report on Friday. Market has crossed over the 364 area, which sits as our point of control level. And as long as this market's able to trade somewhere near this area or above, we anticipate an upward move up until the middle of June will continue to hold. Right now, upside targets that we're looking at sit at about $4 for this contract. That remains to be seen, but over the course of the next several weeks, we'll continue to monitor the market to see where support and resistance continues to live. As evidence from this perspective, we can see how volatility-based support played a very key role in helping to support prices. We discussed how the range between 361 and 354 was potentially very good support. The market came inside of this area, touched the bottom end of that 354 number, and has since rallied from there. We currently have support just above 361. And once again, as long as this market's able to hold near or above that threshold, we anticipate continued strength to the upside potentially. We also have our sinusoidal wave that proved to be very good resistance on the first advance or first test up against the market. And this could very well be the trend in which the market looks to trade as it makes its way up into the middle of June. For now, the key operating level that we'd be looking at for support and resistance would be overhead at 374, intermediate support over at 366, and downside support at 361. These three levels should prove to be key for this contract over the next coming weeks. Moving on to the July contract, we see the exact same price pattern as the market was trending along. Got a nice advance to the upside, and the market has now broken above 370, which was key resistance before. The market came up, tested our level just above at 380, which is where it found good resistance with a minor pullback right now. So similar to the previous contract, as long as we can hold key support near that 370 number, we anticipate the market could very well continue higher. And that 370 number happens to coincide with our point of control, which sits at 372. Volatility-based support for this contract held very well. Right in the middle of the zone was our 45-degree angle at 365.5. Again, the market moved up to resistance near 375, came back down, and now we're finding reasonable support sitting right on top of our sinusoidal wave. The December contract found excellent support at that 380 number that we had discussed previously. Upon moving up from there, the market broke away from our one-by-one upside angle, and once it got clear motion through that angle, it went straight up to our 2x1 downside angle, and now we're looking at 2-bar pullback, sitting right up against support near 386 or so. That 386 to 387 number happens to be one standard deviation below the point of control. And so from here, the market looks to perhaps just maybe trend or tread lightly sideways. And if it's able to actually pick up some strength, even perhaps advance to the upside with some momentum. Like the other two contracts, volatility-based support played a very key role in helping the market to find support. And the 180-degree mark happens to be a very important threshold for contracts or for markets in general. Overhead resistance then looks to be at that 135-degree mark at 392.5. And once the market's able to break through there, the next key area that we would look to test is 402.5. 402.5 happens to be where the previous highs were. And once we break through there, maybe getting up to about 410 to 412 is reasonable. Moving on to May beans, as evidence on this chart here, we can see that the report was quite bearish from Friday, pushing the market even lower. Of particular interest, we can see the continuation pattern that was actually established in the market here. The way in which this pattern establishes itself is if we watch what the market does coming into this particular continuation pattern, we will often see a mirror move come out of the other side. We've already outlined where that level lived, and that level came in at 940. So 100% correspondence from the move down into this continuation pattern reflected on the other side means that the market was looking to touch 940 at a minimum. Not only did the market come in and touch this level, but it has since bounced from here, and we can see how the market came in and touched right up against one of our quartile levels for key support just below that 940 number. The market has since bounced from here. It remains to be seen as to whether or not this level is going to be a very strong support level, but in all likelihood, what we're looking for here is for the market to potentially trade sideways at the very least and find some potential accumulation over time before it can finally start to find some legs in the middle of the month. From this vantage point, we can see that the market is actually in between two key degree factor markers, the 90 degree and 180 degree mark, where it sits right in between. What that suggests then is if the market's not able to get back above this 955 level by the week's end, then there's a good chance then it may test 924.5 and then potentially start to base before it can finally find some legs and start to ease its way back up again. Again, we're looking for a potential consolidation pattern that's a little bit sideways for the next 2 to 3 weeks before the market can find its way back up. To no surprise, we see the exact same pattern with the July contract. We see our continuation pattern right in the middle of the move. And then on either side, we can see the extent of the move where we saw the drop and a mirror move to the downside. One standard deviation below the point of control for this contract sits at 960.5. It is no surprise that this is the area where the market is finding a little bit of potential consolidation. Once this market is able to edge back above this 961 level, then we can potentially look for some accumulation or at the very least some sideways movement for this contract. From this vantage point, we can see that this contract actually is sitting at a very important 90 degree factor, which is at 952.5, and it's bouncing up from here. And so that leaves us with little doubt that the market can in fact find some strength and at least again move sideways. This move could very well move in conjunction with our sinusoidal wave. So be on the watch for a potential move that simply trades alongside our sinusoidal wave here. Rounding out our soybean contracts, we can see the intersection of our two 1-by-1 angles as the market came in here as a very key inflection point for this contract. Here, one of two things will often occur. Either the market will come into this inflection point and turn up, or the market will actually accelerate on the other side upon transitioning out of that inflection point. In this particular scenario, what we find is that the market did in fact explode to the outside after having formed a continuation pattern. That continuation pattern was much like what we described previously, where the length of the move into the market is consistent with the length of the move on the other side. In doing so now, the market has found some support near 950, and we'll continue to monitor that, but it does bear noting that that 950 number is very close to the point of control of 955. So for the market here, depending on where it breaks, it's going to be very key. Again, we're simply looking for a nice little smooth sideways consolidation for this contract before it can finally get some legs. Interesting to note here that the support that we've found over the last couple of days sits right at 949, which is our 135 degree mark. Also, it's the top end range of our volatility-based support band. So again, that leads us to believe that there could very well be reasonable support for this contract. The surprise move last week came at the hands of wheat futures, as wheat followed the coattails of corn and actually had a reasonably strong advance. The next day it moved up again, but gave much of it back up and has since been moving sideways, and the market had been oversold for quite some time, so in essence it had really been due for a potential advance. What we're looking at now is for the market to keep moving up slightly up to resistance, but long term, we still continue to believe that the market is due for a nice collapse to the downside. Keep in mind, in terms of the supply narrative, the US is responsible for only about 8% of the worldwide global supply. That being the case, regardless of what really happens on our side here, something significant would need to occur on the supply side globally to change the bearish narrative that lies before us. In doing so, then, what we would be looking for is for the market to potentially move up to being overbought again. And upon doing so, to give us a nice decline to the downside, that should be reasonably lower than what we're looking at right now. So if the market were to, let's say, advance up to resistance near about 450 and then give us a nice decline again, we would not be surprised to see the market move down to about 420. Interestingly enough, the low last week on Friday did happen to bump up right against the bottom end of volatility-based support. And that low end of that watermark also happened to be at our 127% extension of the previous leg move at 431. So having had both of those pieces come in as confluence probably added to the market being able to find very good support here that helped in the advance up. Now, as the market looks to make its way up higher, we like that resistance near 450 or so, and that does coincide with our sinusoidal wave for this contract. So a move up to about 450 that then starts to turn back down, perhaps even along the timeline of the next couple of weeks or so, could very well mark the beginning of the next move to the downside. We can see much of the same here for the December week contract. Overhead resistance potentially for a short looks to be about 485.5, and from there for the market to potentially move down, perhaps even testing as low as 453. From here, we'll simply watch to see how the market develops and just simply keep our eye on the key support and resistance levels that stand before us. Crude oil futures are moving as would be expected. We went ahead and applied the overbought, oversold indicator on this chart for your viewing. You can see that the market has now moved up into being overbought, and that is in coincidence with our 52 level that we had mentioned before for potential retracement resistance zone for this contract to approach. It is now at that number, and not only did it reach it, but the market has actually reversed fairly strong off of this area, and now we've been moving up from the low about 7 to 10 trading days. Given that fact, then, the market then is looking to potentially ease off of its recent advance. We want to play it safe. And so what we're looking at here then is the potential with continued weakness for the market to make a nice leg to the downside that perhaps looks to test 46.25. Thank you so much again for joining us for our weekly market update, and look forward to touching base with you again next time.